What is up, my fellow economic warriors, and welcome back to Boss Economic World. The only show on the internet that peels back the layers of the financial onion without making you cry, unless you're heavily invested in the wrong places, in which case, we've got digital tissues in the comments section. Today, we're diving headfirst into the dragon's den. The date is November 7th, 2025, and the headlines are screaming bloody murder. China's export juggernaut stalls. The world's factory grinds to a halt. It's the kind of news that makes Wall Street traders spill their third nitro cold brew of the morning. The big, scary number everyone's freaking out about? China's exports in October fell by 1.1% compared to last year. Now, I know what you're thinking. Boss, 1.1%? I've had dips in my crypto portfolio bigger than that before my first coffee. And you're not wrong. But in the world of global trade, where China's export machine has been the one constant, like Gravity or bad superhero movie sequels, a negative number is a full-blown plot twist. This is the first time the engine has sputtered in 8 months. So, the question is, did the Made in China global party bus just hit a speed bump, or did the engine just fall out onto the highway? As always, the truth is way more fascinating, and a little more bonkers, than the headlines. Buckle up. To understand this export dip, you have to picture China as the world's biggest, most efficient restaurant. It's got something for everyone on the menu. For years, its main customer, the VIP in the corner booth, has been the United States. This customer orders everything, every day. Appetizers, main courses, desserts, the whole shebang. But lately, that VIP customer has been on a diet. A tariff diet, to be precise. In October, shipments to the US plummeted by a jaw-dropping 25%. 25%. That's not a diet, that's a hunger strike. The VIP basically looked at the menu and just ordered a glass of water. Now, China's a smart restaurateur. For the last few years, it's been hustling, opening up its doors to new customers. The rest of the world, Southeast Asia, Latin America, the Middle East, they've all been flocking in. And in October, these other customers actually ordered more. Shipments to everyone except the US were up a respectable 3.1%. But here's the cold, hard math: when your number one customer, who used to order a $1,000 feast, suddenly only orders a $750 salad, and 100 new customers collectively order an extra $31, well, you see the problem. The till is short. The 3.1% gain from the rest of the world wasn't nearly enough to plug the 25% hole left by America. And this caught everyone off guard. The folks at Bloomberg polled a whole roomful of economists, the supposed best and brightest. The consensus was for a 2.9% increase. Almost all of them got it wrong. It's like a weatherman predicting a sunny day during a hurricane. It just goes to show, in today's economy, the only thing you can predict is unpredictability. Okay, so the US trade spat is the obvious villain here. But if you think this is just an external problem, you're only seeing the tip of the iceberg. The real story, the one that should keep you up at night, is what's happening inside China. The smart folks at Barclays are calling it a potential triple whammy, and it's a doozy. Think of the Chinese economy as a three-legged stool. For the longest time, all three legs were solid oak. Now, two are looking like wobbly IKEA particle board, and the third one just took a hit with a sledgehammer. Whammy number 1, the property sector. This isn't just a slump, it's a slow-motion implosion we've been tracking for years. The Evergrandes and Country Gardens of 2021 to 2023 were just the opening act. Today, in late 2025, the hangover is real. For decades, the average Chinese family stored its wealth in real estate. Your apartment was your 401k, your nest egg, your everything. When its value drops, you don't just feel a little poorer. You feel like your entire financial future is cracking. This negative wealth effect is brutal. People who see their primary asset shrinking don't go out and buy a new car or a fancy new 8K television. They hoard cash. Whammy number 2, weak private consumption. This leads directly to our second whammy. The Chinese consumer is spooked. After the whiplash of the zero-COVID lockdowns ending in late 2022, everyone expected a tidal wave of revenge spending. It turned out to be more like a ripple in a bathtub. People are saving like crazy. The household savings rate is still stubbornly high. They're stuffing money under the proverbial mattress because they're worried about their property values, they're worried about their jobs, and they see a wobbly economy all around them. The government is throwing out coupons and begging people to spend, but it's like trying to start a party in a library. The mood just isn't there. Whammy number 3, the wobbly export leg. And this brings us back to today's headline. Exports were the last leg of the stool that was holding strong. While the domestic economy was sick in bed, the export machine was running a marathon, keeping the whole thing propped up. It was the one bright spot. Now, with this minus 1.1% print, that leg is starting to wobble. If you have a property crisis at home, consumers who won't spend, and your global customers start buying less, that's the triple whammy. That's when the stool doesn't just wobble, it collapses. Now, let's not underestimate China's hustle. They didn't get to be the world's factory by sitting around. As the US market became more hostile, Chinese companies started playing a brilliant game of global whack-a-mole. A tariff pops up in America? Whack! They flood Brazil with BYD electric cars, which are now outselling every other EV brand there. The US bans certain tech components? Whack! They build entire smart city infrastructures in Dubai using Huawei and SenseTime tech. American consumers are tired of high prices? Whack! They create new ultra-fast fashion giants like Temu and Shein that have perfected the art of shipping directly from a factory in Guangzhou to a teenager's bedroom in Ohio, completely bypassing traditional retail. They got creative with supply chains, too. The famous made in China, assembled in Mexico, sold to the USA trick. A product would be 95% finished in China, shipped to a factory in Tijuana, have a final screw put in, and then, presto, it's a product of Mexico, sidestepping a whole bunch of tariffs. But in October 2025, the moles started fighting back. First, the slowdown isn't just a US thing anymore. Shipments to the EU crept up by a measly 1%, the slowest pace all year. Germany's industrial heart is sputtering, and when Germany catches a cold, all of Europe starts sneezing. Then you have other major markets outright dropping. Sales to South Korea, Russia, and Canada all fell by double digits. These were supposed to be the reliable B-list customers. And even the whack-a-mole strategy is hitting its limits. Mexico, under pressure from the US, recently announced new import curbs specifically designed to stop that final screw loophole. The moles are getting smarter. Then there's the currency. The yuan has actually been getting stronger against the dollar this year. For an exporter, a strong currency is a headwind. It's like you're trying to run a race, and someone keeps increasing the price of your running shoes. It makes your goods more expensive for foreign buyers. So, the strategy of finding new markets, which worked brilliantly for a while, is now showing signs of fatigue. The whole world is slowing down, and there are only so many moles to whack. Okay, so everything I've said so far sounds pretty gloomy, right? The stool is wobbling, the moles are fighting back, the headlines are screaming. But now, we get to the Boss Economic World part of the show. The part where we restore the full picture. Because if you only look at that minus 1.1% number, you are missing the biggest, most important twist in this entire story. Despite the October dip, for the first 10 months of 2025, China has exported over $3 trillion worth of goods. That's a record pace. And get this, China's trade surplus, the difference between what it sells and what it buys, has hit an astronomical $965 billion so far this year. Let me say that again, nearly $1 trillion surplus. In the third quarter alone, the current account surplus, which is an even broader measure, hit a record $196 billion. Wait, what? How on earth can a country have a record-breaking, mind-boggling surplus at the exact same time its export engine is reportedly stalling? Is this some kind of new math? No. It's the other side of the equation that nobody talks about, imports. China's overall imports grew by a pathetic 1% in October. They are buying almost nothing from the rest of the world. Why? Go back to our triple whammy. The property market is in the tank, so they don't need as much iron ore and copper. Consumers are scared, so they're not buying German cars, French luxury bags, or American iPhones at the same rate. Domestic factories are worried about the future, so they're not investing in new foreign-made high-tech machinery. Think about it this way, China has become a factory that is running its assembly lines 24/7, pushing products out the door at any price, but has completely shut down its own purchasing department. The result is a mountain of cash piling up, but it's a symptom of sickness, not strength. It's a sign of a deeply unbalanced economy that is relying on the rest of the world to absorb its output while its own domestic demand has flatlined. And there's another secret weapon in this paradox, price. Even though the yuan got stronger, the prices of Chinese goods being shipped abroad have been falling for almost every single month since mid-2023. This is domestic deflation being exported to the rest of the world. Because demand is so weak at home, Chinese companies have a massive glut of unsold goods. What do you do when you have too much inventory? You have a sale. A global clearance sale. They are slashing prices to the bone just to keep the factories running and the workers employed. For American and European consumers, this is great news in the short term. Your new solar panels, your kids' toys, your kitchen gadgets, they're all cheaper. But for competing factories in Germany, Japan, or Ohio, it's a nightmare. They can't compete with a country that is desperately exporting its deflation. So, the paradox is solved. The surplus is massive not just because they're selling a lot, but because they're buying very little and are selling what they do export at bargain bin prices. So, where do we go from here? Is this the beginning of the end for China's export dominance, or just a painful transformation? Let's look at the bull case first. The optimists at Goldman Sachs are talking about structural tailwinds that will keep exports resilient into 2026. What they mean is that China is no longer just exporting socks and plastic toys. It's cornered the market on what the world needs for the 21st century, the new three: electric vehicles, solar panels, and lithium-ion batteries. This isn't about cheap labor anymore, this is about a massive, state-supported technological and manufacturing dominance in the key industries of the future. While the West was debating green policy, China built the entire supply chain. This is a powerful, sticky advantage that won't disappear overnight. And we have the recent truce between Presidents Trump and Xi. Starting next Monday, the US will reduce tariffs on some Chinese goods by 10%. This might provide a little bump for the holiday season. We're already seeing signs of it. Container traffic at Chinese ports jumped in the last week of October, likely from companies front-loading shipments to get ahead of the holiday rush and take advantage of the lower tariffs. But let's be real. A 10% cut is a bandage, not a cure. Chinese goods will still face higher duties than those from Vietnam or Mexico. The deal is a truce, not a peace treaty. The fundamental rivalry is here to stay. So what's the real takeaway for you, the savvy investor, the curious citizen, the economic warrior? Don't get fooled by the simple headline. The minus 1.1% export drop is a critical warning sign. It shows that China's old model of simply overwhelming the world with volume is hitting a global wall of slowing demand and political pushback. The Chinese economy is now a profoundly two-faced beast. On one side, you have a sick domestic dragon, weighed down by a collapsing property bubble and terrified consumers. On the other, you have a ruthlessly competitive export machine, shapeshifting from cheap goods to high-tech essentials, and willing to slash prices to maintain its global market share. The grand, multi-trillion-dollar question for 2026 and beyond is this: can the export machine keep running long enough for the domestic dragon to heal itself? Or will the internal sickness finally drag the whole operation down? The rest of the world is caught in the middle, enjoying the short-term benefits of China's global clearance sale, but facing the long-term threat of a competitor that plays by a completely different set of rules. This isn't a simple story of decline. It's a story of desperate adaptation. And it's the most important economic story on the planet right now. That's all the time we have for today, folks. Don't just read the headlines, demand the full picture. Stay sharp, stay informed, and remember, in the world of economics, the most interesting stuff always happens in the footnotes. Hit that like button, subscribe for more, and I'll see you next time on Boss Economic World. Peace out.